Hello, Eric. How are you?
Good. How you doing, Ed?
Good. Everything okay in California?
It's all good.
Good. Yeah, we're good here too. Lots to talk about, so let's focus on the issues of the day. The good news today was retail sales. Retail sales. The uh, the headline number wasn't so great. It was only up 0.2. Give us the other details on the retail sales report that was mildly encouraging.
Yeah, so the control group, which is what actually feeds into GDP, was up 1% month over month. So completely reversed the January decline. And if you actually look at, which specific sectors rose and fell, the biggest category was online sales, up 2.4% month over month, huge increase. And then the biggest decrease was basically eating out, down 1.5% month over month. So it does support that, bad and cold weather story.
Yeah, I mean, January was the coldest January since 1988, and February, not sure how it compares to previous Februarys, but it was above average cold weather for a February. So I guess everybody hunkered down in January and didn't go out to restaurants and didn't even order from Amazon, though maybe everybody kind of had been shopped out on online shopping from the Christmas holidays. But then February was cold again, and it looks like they ordered again. What did you say? Did they go out to restaurants in February, or was that week again?
No, that was
Yeah,
the weak category.
yeah. Okay, so we should. Chauncey Gardner once said, "In the spring there will be growth." I think that was the book being there and the movie being there with um, oh, I forget his name. What's his name? Sellers. Anyways. One of the folks in our audience, if you would put in the Q&A the name of the actor from being there, I'd appreciate it. Thank you. Anyways, the we'll see what the Atlanta Fed does with that data, but uh, Peter Sellers, of course, I had that on the tip of my tongue. Thank you. And that was Sharon. The retail sales numbers looked good. Not so good was the New York State or the New York Fed's survey of business activity in the state in the region, and it was down sharply, and that would be for March. So that was disconcerting, and also the price indexes were up, and that was, I think, all indicative of the tariff issue that is hitting the economy. So we're still betting on the resilience of the economy, at least on the consumer side, but there clearly is going to be some weakness in the business side as businesses have to deal with the tariff issue, and it looks like this isn't going to go away anytime soon. That's our problem when I guess we just have to listen to Trump carefully and take him at his word and that he means what he says. And he said that he'd like to use tariffs as a way to get other countries to treat us fairly. And so the idea there is you have reciprocal tariffs. You say, we've added it up. We looked what your official tariff is. We looked at all the other games you play to make it hard for us to export to you. We figure it's instead of a 10% tariff, it's more like a 25% tariff. So that's what we're going to reciprocally impose on you. And if you want to talk about it after we do it, I think the administration recently came out and said they're not going to negotiate these things before April 2nd. And that's
Mhm.
because I think they're just scrambling to figure out what the relevant effective tariffs are. So once they figure that out and impose them, then there'll be negotiations. And silly me, I thought that the main point was to create an environment for negotiating tariffs down. But again, listening to Trump saying what he's been saying during the campaigns, he said he also wants to raise revenues with it. Well, that's a permanent tariff. That's not a transitory tariff. And then he's also said that he wants to use tariffs as a way to force companies to come back to the United States. And again, that's not a temporary tariff. That's a permanent tariff. Um, But the market had a nice bounce on Friday, and I came up with the observation that any day where Trump doesn't say anything about tariffs is a good day for the markets. And so we had a good day on Friday also because the government didn't shut down. And so that was a nice bounce there. But we're not quite sure that that was the bottom. All the sentiment indicators, the bull-bear ratios, investors' intelligence is down to zero point 0.8. It got as low as 0.66 during the previous bear market. So zero point 0.8 is a screaming buy signal from that indicator, as is the bull-bear ratio from the AAII survey. But what we've observed is that these bearish sentiment indicators work real well as buying signals when they are associated with an economic environment, financial environment where the Fed exercises the put, where the Fed comes in and lowers interest rates. And that doesn't look like it's going to happen on Wednesday for sure. And I think the story from the Fed, well, what was the last story that Powell told us, and what do you think he'll just kind of repeat that again at the Wednesday presser, Eric?
Yeah, just that the economy's in decent shape, which I mean we still pretty much agree with, right? It's only been a little bit of a soft patch. We'll see how the rest of the data tomorrow comes out with, but I don't think there's anything in the data to lead them, to be more dovish than they've been already. But I think if things do deteriorate, they could easily flip that switch and go back to cutting again.
Yeah, in other words, we've been saying none and done, but we're not going to. We're going to be realistic here. Given, 2 weeks ago we raised our recession subjective odds from 20% to 35%, and a week ago we lowered our upside expectations for the S&P 500 by year end to from 7,000 to 6,400, and that was not because we cut our earnings, which still remain maybe too high, but they really are right up there at 285 for this year and 320 for next year. Obviously, if the economy actually does start to show more signs of falling into recession, we're going to have to cut there. But our entire slicing of the outlook for the S&P 500 had to do with our perception that we all know that valuation multiples are high, that they're stretched, but we've been justifying them. And I guess when you start justifying high multiples is when it stops working. But we have been saying that we didn't think there's a prospect for a recession anytime soon. And as long as the market agrees with us after 3 years of seeing the economy prove itself resilient, then valuation multiples could stay high. But wouldn't you know it, that all kind of came unglued here just in a matter of a couple of weeks because of this. The market and we came along to the realization that this tariff thing wasn't going to go away, and it poses a bigger threat to the economy and to the global economic system. So having said all that, as I said, we turned clearly more cautious and remain sort of vigilant about how things might continue to deteriorate. So that's where we are. But yeah, the Fed might come to the rescue in that situation. Much depends, of course, on inflation. If tariffs do in fact create at least a temporary inflation problem, the Fed might hold off on the Fed put. If the economy looks weak enough, they might proceed with it. But I think, as Eric and I pointed out, the Fed's stance is a dovish one. They've been saying that they are in no hurry to lower interest rates. They never said that they're in no hurry to lower or raise. That they never said they're just going to kind of keep them here. But they're obviously still inclined to think about lowering interest rates. At least that gives us something to hang on to as a offset to the Trump situation with tariffs. So, anyways, just to keep ourselves honest and balanced, we wrote a piece for today called "The Case, the Bear Case versus the Bull Case." Eric, why don't we look at some charts? Unless you got anything else you want to throw in before we get there.
No, let's do
Okay,
it.
here we go. Showtime. Okay, so March 17th is today. Happy St. Patrick's Day. Um, we've been writing about the valuation issue. It just maybe we've been too sanguine about it, and maybe when all is said and done, we'll find out that Warren Buffett selling and raising cash just showed that he was true to his metrics, and he's a big fan of his own uh, Buffett ratio. So the Buffett ratio is basically the price to sales ratio. We can do that on a weekly basis. So that's forward P to S versus the forward PE. And the forward PE didn't get close to the level that it had been before the tech wreck, but it got certainly high enough, and it was more or less comparable to what we had during this period here, following the lockdown. When we had the lockdown rally in the post-lockdown rally in the stock market, and then meanwhile the PS ratio went to an all-time record high. We only have on a weekly basis we have it this far back, but we do have it back on a quarterly basis all the way to the 1960s. So this is the Buffett ratio. In this case, is defined. Well, you can see it here: the total value of U.S. corporate equities at market value divided by nominal GDP. And so that's the way that Buffett talked about it. I think he talked about it way back here as, whenever you get to two, he feels uncomfortable. So obviously he's been uncomfortable for a while because it got well above that, over three. And even in the latest quarterly available data, which I guess is, where is that? Fourth quarter of 2024, that was historically high near that peak. And then again, we can watch it on a weekly basis. So we've had a valuation issue. As long as the prospects for the economy were fine, it was sustainable, but not so as recession fears have come into place. And you know what? For the past 3 years, we've steadfastly argued against a recession, even with the Fed raising rates, and we've argued about that the economy is resilient. But we try to be realistic and data driven. And again, we acknowledge that the risks of a recession from Trump tariff turmoil have been increasing. We still think the consumer is going to hang in there. We still think the labor market's going to hang in there, but that's where we are. So one of the reasons, by the way, why this ratio is higher, why the Buffett ratio, PS, is higher than the PE ratios, because profit margins have gone up. So that's something to consider when you're looking at the difference of the two. This is the profit margin on a forward basis. So we're still using the same trajectory for forward earnings that we've been using all along, acknowledging that if we are forced to raise our recession odds anymore, we're going to have to respond and reflect that in our forward earnings projections. But this is a no recession scenario, clearly. What we did is we lowered our PE ratio, the range from 18 to 22 to 18 to 20. And meanwhile, the markets, technically speaking, looks pretty oversold. The Nasdaq took a dive right through. I mean, this is unsettling to see the market kind of go like that. But every single day, it seemed as though Trump was saying something about tariffs that got the market upset. And so it was very much data driven, is Trump driven. And we saw the same thing with the S&P 500. So let's talk about the bear case quickly, because I like to be happy, but I also, I guess, have to be realistic. Eric, tell us about should we be paying much attention to the consumer sentiment index, for example?
Yeah, I mean, it's been depressed for a while, but it's definitely plunged across kind of the various things that it reports. But now you're starting to see it also in earnings calls, like low budget retailers, airlines,
Mhm.
they're all starting to say that, hey, this sentiment is evident in our data and like our sales are going to suffer. So, it's been a pretty good few years. Maybe people are starting to pull back, or
Yeah.
there's just a lot of uncertainty there. So why keep pressing the gas?
Yeah, as you said, this does tend to be a pretty depressing indicator. I mean, it's been depressed for quite some time here. This was the pandemic low, and we've basically been below that. And yet, consumer spending in real terms, all-time record high. So it's concerning. But then we've also had this spike up in expected inflation in the consumer sentiment index. We think that the consumer sentiment index is more sensitive to inflation than is the consumer confidence index. Consumer confidence index seems to be better at giving us a read on the labor market, and that still looks decent. And by the way, there's the Federal Reserve Bank of New York has a survey monthly that still is pretty low for that's for expected inflation, and that's still pretty low. So there's a bit of a discrepancy between these things. So, Eric, I don't want to get political, but sometimes I wonder if the consumer sentiment index has more Democrats in it than Republicans. Because if I was a Democrat, I'd be pretty depressed for sure. And I could understand. I feel their pain. I can understand why. Anyways, gasoline prices used to be the main driver of expected inflation, at least in the consumer sentiment index, and gasoline prices have remained low. So it's obviously something else, and I think they're watching the evening news, and the evening news is correctly saying that it's conceivable, common sense, that tariffs could at least for a short period of time lead to higher prices, and that's got to be disappointing even for people who voted for Trump, because a lot of people who voted for Trump basically wanted the border closed and they wanted to see uh, food prices come down. And Trump promised to bring gasoline prices down as a way to bring a lot of other prices down. And here, tariffs are are going to cause prices to go up in some area. And it's nice for the administration to let us know that there might be some pain in order to have this golden age and great gain. But the reality is, a lot of people really pretty feel like they've experienced a lot of pain over the past 5 years with the price increases. I've seen, 20 to 25% price increases, auto insurance, home insurance. So it's not a compelling story to tell people that hey, you're going to experience a little bit more pain. And besides, Americans don't do pain very well. We like to be happy and we like things to go well. Anyways, this is a chart that we've been showing. Eric, tell us the happy story on the baby boomers, and tell us why this could come back and bite us.
Yeah, so baby boomers have a lot of wealth, and a lot of that is in equities. The other major source is their real estate, and obviously home prices are still pretty high. But baby boomers have $25 trillion in mutual funds, ETFs, wherever they're holding equities, Apple. And so that's been a huge source of it's kind of depressed the savings rate, right? Because they have no income, but they have a ton of wealth that's growing pretty rapidly, so they're free to spend if they feel like, and you're very sensitive to a 10% decline when you're retired and living off that type of income, non-labor income. If they decide to stop spending, that could definitely weigh on a lot of the places we've seen consumer spending, which is, leisure, hospitality, stuff like that. So yeah, I mean, it's a
Yeah.
huge driver thus far. So it could have a pretty significant marginal impact if it
Well, in corrections, everything kind of goes down into some more than others, but I notice the cruise line stocks have been weak, gambling stocks have been weak. So, like you said, people who are retired, who were feeling like life was perfect, going in their favor, they retired, their home prices were going up, their stock portfolios were going up. They'd spend money and still have more net worth at the end of the month. And now they're seeing a pretty significant haircut. And a 10% drop in your stock portfolio probably hurts a lot more and scarier when you're retired than when you're still working for a living and you still got plenty of years ahead of you before retirement. So that could turn on us. Then, of course, there's the issue of uncertainty. How is this all going to play out? What's the impacts on the domestic economy, the global economy? I mean, to say that there's going to be a golden age in America doesn't really add up if the rest of the world suffers as a result. It's not, it shouldn't be a zero-sum game. It's hard to see how the U.S. prospers if Europe and China and other parts of the world are struggling because of tariffs. And by the way, global stock markets are telling us that so far the U.S. is not the winner from all this. It's more foreign markets, and maybe it's because the perception is if the U.S. is going to go it alone, then the U.S. is going to go it alone. Other countries aren't going to start to go into a tariff war with each other. Quite the opposite. They might be say we got to become less dependent on the U.S. But so this creates uncertainty, which then affects the CEO confidence. This is the Business Roundtable CEO confidence. That's for the economic outlook, and you can see, not surprisingly, that correlates quite well with capital spending on equipment and real GDP in this situation. And then Eric and I have been monitoring, as I think everybody else has been monitoring, the uncertainty index that the NFIB Small Business Survey has been showing, and it's a pity because we really did get indications that business optimism, small business optimism, was really picking up. Another example of animal spirits, but animal spirit seems to be being offset by uncertainty. This is just a look at the this. I forget the where we were flowing with this thing, but oh yeah. Oh yeah, one of the issues with for the bear market is that it's not just tariffs; it's also the recognition that AI isn't going to be as easy to make money with that technology, and so ever since DeepSeek came around, we've seen the Magnificent Seven taking a dive. And meanwhile, these are the Chinese technology stocks. They've been going up, and of course, if the Magnificent Seven are going down, the Nasdaq's going down. And so that's another. We're on the bear case here. So the bear case is everything's going wrong, even the excitement about AI. And then, of course, tariffs can impact depress global exports, and if they depress global exports, they will have an impact on the global economy. It's as we just kind of mentioned. Eric, you want to go over this negative contrarian indicator?
Yeah. So, foreigners buy a lot of US assets, including stocks, not just treasuries. And they're pretty bad market timers. They tend to chase the tops and then sell the bottoms. So, I mean, you can see that in 2021, they were buying when meme stocks were hot, and then they sold at the bottom in 2022. So, we were kind of saying they saw this latest rally in Q3 and Q4. They started buying a lot. Maybe that, preceded or precipitated like, hey, this was a little overdone.
The good news is it looks like it's just been the past few months.
Yeah.
So it's not kind of like what we saw back here, for example. And then, of course, that gets to the issue of American exceptionalism, and this chart has been one way to track American exceptionalism, in that the U.S. economy has outperformed the other economies. The stock market here is outperformed. We have the Magnificent Seven, and they don't. I would say that one of the positive aspects of this of Trump so far has actually been to stimulate the global economy. I do think that America is exceptional in all sorts of positive ways, but let's face it, we also are exceptional in the amount of government debt that we've accumulated, and now we've managed to convince China and Germany that they need to increase their deficits a lot more and spend a lot more. So that's actually stimulating the Chinese economy. And we've been, U.S. government officials have been trying for a long time to get the Chinese government to stimulate consumer spending. And we're looking into the specifics of this program that came out over the weekend. And obviously, they've kind of figured out that if they're going to be faced with tariffs, a tariff war with the United States, they've got to stimulate their domestic economy. And it looks like they're going to do what they can. I'm somewhat skeptical that they're going to be able to do that. I think Chinese consumers have the geriatric issue that will weigh on consumer spending. But at any event, we'll be watching this. And a couple of weeks ago, we said if you want to go global, we're not going to fight you on that. And of course, valuation multiples. If you look at the all-country world, excluding the U.S. PEs, 13.8. The U.S. is 20.7. Probably by now it's about 19, excluding the magnificent seven. So people have been looking to get out of high valuation stocks, particularly in the U.S., and finding better value overseas in China and in Germany. But let's see what happens on April 2nd when the retaliatory reciprocal tariffs, not retaliatory, reciprocal tariffs hit, and then maybe that'll be followed by retaliatory tariffs by other countries. Let's see what that does to stock markets in China and in Europe, because obviously it's hard to imagine that tariffs would be good for their economies. Eric, let's say some happy stuff here. Retail sales, we just got a number. It looks okay. And so tell us about the Red Book.
Yeah, the Red Book retail sales come out weekly, and they look, much better. They've been between 5.5% and 6% year-over-year growth. So I don't know, if January and February are just the weather, or at least unduly weighed on by the weather, we should see a bounce back in March. Labor market still looks okay, so consumer spending might be hanging in there.
And then this is just a couple of components there. The department store sales just don't grow, but even they've started to show some growth. And then the discount sales are quite solid. Yeah, I think we can mosey along here because I think we're going to have some questions that we would definitely want to get to. But initial claims look okay. We're monitoring the federal government employees' unemployment claims. Obviously, those are going to start going up. But this is, we're talking about 1,600. We're not talking about 1.6 million or 16,000. The numbers so far, at least in this area, are small. But there's also some quirkiness about this whole federal government employee system. It's apparently it takes quite some time to fill out the forms and get them approved. The idea that we're going through another tech wreck. I know Jim Grant put out a good piece on why AI is kind of similar to .com. At least I skimmed it, and I think that's what he was getting at. But here's the capitalization share of information technology and communication services, 40%, about the same as it was right at the tech wreck, right before the tech wreck. But back then, the earnings share was 22%. This time around, it's 35%. And we think a lot of these tech companies have a great future. They're not .com companies. So we're still, we view these sell-offs as opportunities in tech, not as reasons to panic out of them. And that's it. We did focus more on the bear case because we've been telling the bull case for so long, and I think you guys all know it pretty well. Eric, why don't we take a few questions? Sorry, this is going to take a little longer if you want to hang around, folks, just so we cover some of your questions. Eric, take it away.
So I think the first two kind of touch on, what's the difference between reciprocal tariffs being a revenue driver versus a negotiating tool? Could that be a redux of, a century ago, or are we going to be seeing lower trade barriers?
Well, I think the Smoot-Hawley tariff was imposed willy-nilly by Congress without any consideration for the possibility that there could be retaliation. And it was just kind of an orgy of congressional representatives telling their constituencies that we're going to protect them from all the bad people overseas. And then the bad people overseas said, well, if that's the way you want to play the game, then we'll retaliate. And that because of the Smoot-Hawley tariff, perversely, ironically, when we look at the current situation, Congress passed the Reciprocal Tariff Act, I think it was in 1933, thereabouts, maybe 1932. But the Smoot-Hawley was passed in June of 1930, and it collapsed the global economy so quick. We saw commodity prices collapse. Farmers couldn't make their mortgage payments. Banks went under. I know that there's a theory that a lot of it had to do with the Fed and the monetary system, but I'd like to look at charts, and when I see things free fall at the same time that Smoot-Hawley tariff is imposed, I think it had a lot to do with it. And in Congress, a couple of years later, recognized that and said, let's take this power away from us. We're too dangerous, and let's give this power to the president. So President Roosevelt, with the reciprocal, not the retaliatory, but the reciprocal tariff act, was given the power to reduce tariffs in the negotiations. And his Secretary of State, Cordial Hall, did that. And that was, I think, a big reason why we got out of the Great Depression, or things started to improve, at least during the first half of the Great Depression. Then there was another wave of depression related to other issues. So retaliatory tariffs are what other countries are going to do in response to our reciprocal tariffs. They're going to say, well, we're going to raise it further, or they're going to negotiate. Say, okay, we get the point. Let's negotiate them down. But other countries have tariffs for the same reason we have. It's a lot of domestic political pressure. All politics at the end of the day is local. So it may not be that easy to negotiate some of these tariffs down. It could take quite some time. But the word reciprocal sounds happier. It sounds like we're going to match you, and then if you don't like that, let's talk them down. But in terms of raising revenues, I mean, that's just a delusion. There's no way tariffs can be used to significantly raise revenues without creating a global recession that then depresses those revenues. So the idea of having an external instead of an internal revenue service, having an external revenue service, eliminate the income tax here at home, just doesn't really make any sense.
This next one from Cactus is, Ed, what % of the market turbulence do you attribute to tariffs versus a speedy fiscal consolidation? And then as a follow-on, what do we think about the odds that the summary of economic projections, reduces the amount of cuts for the remainder of the year?
Yeah, I mean, I have to wing it here. I have no tools for really getting to it, but I would say, I guess it has to add up to 100%. So I'd say 50% the tariff issue, 25%. See, it's a tough because there's a valuation issue here, right? I mean, I think we all have known for a while that the valuation is kind of high, but we could kind of justify it by the fast growth, particularly of the mega cap of the Magnificent Seven. So I would say, at least 50% is tariff related, and maybe 75% and 25% for the fears that the Doge boys will go too far too fast, and that could slow things down. I think at the end of the day, it's all about suddenly there's a concern that a recession might actually occur as a result of all this. And that's what's depressing the market, and then it's doing it on a valuation on the PE. We have yet to see analysts get the recession memo or the tariff memo. Forward earnings are an all-time record high. Eric, let's take one or two more. Well, what did Cactus want to know about the Fed?
Summary of economic projections.
Oh, what they're going to change?
Yeah.
I suspect they're going to try to low profile that, right? I mean, you have any feelings on that, Eric?
Yeah, I mean, their growth projections already been pretty low. I guess we'll see how much they raise inflation and if they move their projected cuts. But whatever it is, it's not going to reflect how dovish they actually would be if unemployment does rise significantly and growth does slow significantly. So I don't know. It has the chance to positively surprise the market, but I don't think it really says much.
Yeah. You want to take one more, and then we'll call it a day?
Yeah, there were a couple on the Michigan inflation expectation survey. Like, are they really politically influenced, and how legitimate is like a 4.9% outlook for 1 year ahead inflation.
What do you think?
Yeah, I mean, I think it's just a poorly constructed survey. Democrats make up the majority of the inflation expectations increase, and Republicans show that they don't really have much of an expectation for higher prices. But like, just the fact that you're asking that question messes with the survey results, and it's an online survey now. So I think the New York inflation expectations survey is just better constructed. The questions are better. It doesn't change as much over time. It doesn't even matter if you're a Democrat or a Republican when you're asking it. Just the fact that that question shows up is going to change how you're thinking about a survey. So it's a garbage survey, and it was last year, and it still is, frankly.
Let's just take Gus's question here. Does the Fed have cover to lower rates if we see a slowdown in the economy, and does that push the Fed to take a number of cuts? Yeah, I think if the data justifies it, they'll act. They want to ease anyways. It's pretty clear that they keep saying they're in no hurry to ease. And as I said, that's a dovish stance. So they're ready to ease if the data confirms that. But it could be a tricky situation, Eric. What if they get a couple of inflation numbers related to tariffs, and at the same time that the unemployment rate goes up? They're going to have to pull out that word transitory again and say that the inflation is transitory related to the tariffs. Anyways, get a neck brace. The volatility will most likely continue. We've been expecting that the market would be choppy during the first half of the year. Instead, it's been chopping a lot of us, obviously. But looking forward, we think second half of the year we'll be back running into record high territory, and 6,400 is now our target for the end of the year. Thanks, everybody. We'll check in with you next week.
Thanks, everyone.